When you see an asset surging, like nearly 27% in just 6 days, does your brain immediately scream strong buy to catch the momentum wave? Or, does it whisper value trap right before a catastrophic
Oh,
crash?
that is the ultimate psychological tug of war, right?
Yeah.
Especially for anyone putting money into the market right now.
Exactly. And today's deep dive is zeroing in on one specific ETF that forces exactly this debate. We are talking about the ProShares UltraPro QQQ. Or, for those watching the order flow, we're talking about TQQQ.
Yeah, TQQQ. I mean, it's a ticker that generates just a massive amount of emotion, largely because, well, it's a vehicle built for incredibly fast money.
Right.
The standard playbook for index investing completely falls apart when you introduce this level of daily leverage.
It really does. So we are unpacking a heavy stack of current market data, technical analysis, and institutional flow reports from today, April 9th, 2026.
A lot of data to get through.
Yeah, we need to dissect this massive risk-on rally that TQQQ is currently experiencing. The core mission for you listening is to answer this. Um, is this the ultimate structural vehicle for riding the tech and AI boom? Or is it a dangerously overvalued trap waiting to catch retail traders completely off guard?
And answering that, I mean, it requires looking far past the surface level gains. We have to strip the fund down to the studs and look at the actual machinery.
The mechanics under the hood.
Exactly. Because the structural mechanics of the fund are often what, do the most damage to the unaware trader.
Yeah, the stakes here are exceptionally high. I like to visualize it this way. If the standard Nasdaq 100 is a high-speed bullet train, TQQ is like strapping yourself to the nose of that train with an experimental rocket pack.
That is a terrifying visual. But
Yeah, right. The upside velocity is absolutely exhilarating, but the mechanics of the fuel system can absolutely obliterate you if you aren't paying attention to the dashboard.
That captures the risk profile perfectly.
Yeah.
But, before debating whether the current price action is a trap, you have to realize what you are actually purchasing when you click buy on your terminal.
Because it's not a normal stock.
Right. You aren't taking a direct proportional equity stake in a basket of software and hardware companies.
Right. It's a leveraged exchange-traded fund. Its stated mathematical goal is to deliver 3 times the daily performance of the Nasdaq 100 index.
Yep, the daily performance. That word is key.
So, the Nasdaq goes up 1% today. TQQQ is engineered to go up 3%. And to pull that off, the fund commands just staggering resources. The current data shows it's sitting on $24.59 billion in net assets.
Which is massive.
It is. And we are looking at a 52-week roller coaster that swung from a brutal low of $20.12 all the way to a peak of $60.69.
Which, that represents volatility that dwarfs almost anything else in the large cap space.
Yeah.
But the sheer size of the AUM, that $24 billion, is what allows it to function.
How?
Well, managing a $24 billion pool of capital with a mandate to, triple the daily movement of the world's most heavily traded tech index, that requires constant, aggressive financial engineering.
Speaking of the engineering, I was digging into the balance sheet and income statement in the research stack, and the financials look completely broken if you evaluate them like a traditional entity.
No, they look terrible on paper.
Right. TQQQ's revenue is reported as $1.65 million. That is literally a rounding error for a $24 billion fund.
Yeah.
And worse, its net income is sitting at negative $618,000. I mean, wait, a $24 billion fund is running at a negative net income. How does that not immediately terrify investors looking for, stability?
It looks alarming until you factor in the mechanics of the underlying derivative structure. TQQQ isn't just buying shares of NVIDIA, Apple, and Microsoft and letting them sit in a custodial account somewhere.
So what are they doing with all that capital?
To secure that 3x daily leverage, they are deeply entrenched in the derivatives market. They use the fund's capital to enter into massive total return swap agreements with global Tier 1 banks.
We're talking institutions like Goldman Sachs, Morgan Stanley, JP Morgan.
Exactly.
So they're essentially paying a massive premium to these counterparties to guarantee the triple return.
Right.
The banks are taking on the risk of providing the leverage, and they are charging TQQQ a hefty fee for the privilege.
So that negative net income you mentioned, that's just the cost of doing business. It is the interest rate and the premium paid to the investment banks for keeping those swap agreements open.
Basically, the banks are renting out their balance sheets to ProShares.
Yeah, and those contracts are incredibly expensive to maintain, especially in a high interest rate, or, highly volatile environment where the banks demand more compensation for the risk they're underwriting.
Okay, so it's because we aren't looking at a tech company selling software, we're looking at an engine. That negative income is just the cost of the highly combustible fuel, the swaps, needed to maintain that 3x leverage.
That's a great way to put it.
And it also explains the high expense ratio, right? Sitting at 0.82% net or 0.97% gross, you are directly paying ProShares to manage this volatile web of counterparty risk every single day.
You are paying for the daily rebalancing. Because think about it, if the market closes up, the fund is suddenly under-leveraged and has to buy more swaps at the end of the day.
And if it closes down?
They are over-leveraged and have to sell. The portfolio managers are constantly adjusting exposure in the last 15 minutes of the trading session just to ensure they wake up the next morning at a clean 3x ratio.
Wow, okay. So knowing how expensive this engine is to run, let's look at the telemetry on the track right now. As of the latest print in our stack, the price sits at $48.88.
Up 1.82% for the session.
Yeah, up for the session. But the headline here is the aggressive bullish streak. It's riding a 6-day winning streak from a March 30th pivot low, banking a 26.68% gain.
It's a massive move.
And the liquidity is staggering. The average daily volume is printing at 104.31 million shares.
And, the chart setup is generating a lot of noise among technical analysts right now. The price action has pushed TQQQ into a textbook golden configuration.
A golden cross.
Yeah, it's trading comfortably above both its 50-day moving average, hovering around $43.14, and its 200-day moving average at $45.84. And furthermore, the MACD is sitting at 1.57.
So a positive crossover with sustained upward momentum. I mean, on a surface level, the trend looks bulletproof. The moving averages are providing strong support, and the momentum indicators are just screaming green.
Right, on the surface.
But I'm looking at the order flow data alongside the price chart, and there's a glaring contradiction here. Price is ripping, but it's floating up on shrinking volume.
Yeah, that's the catch.
And the RSI is flashing a massive bearish divergence.
Well, the RSI sits at 64.2, which is pushing heavily against the upper boundary, almost in overbought territory. But, the volume profile is the real story here.
If the price is going up for 6 days straight, why is falling volume a red flag? I mean, shouldn't a rising price be all the confirmation we need?
You would think so, but no. When you see a 26% vertical move in the price, you expect to see expanding volume, institutions piling in, algorithms chasing the momentum, retail FOMO kicking in.
But we aren't seeing that.
No. Instead, the total shares changing hands actually decreased as the price went higher.
So it's the classic exhaustion signal.
Exactly.
The buying pressure isn't actually expanding. The selling pressure has just temporarily dried up, allowing the price to kind of drift higher on later participation.
Which means the rally is running out of gas. And the floor underneath these new price levels is incredibly thin.
Right. So if a major holder decides to dump a block of shares into this low-volume environment, the bid stack could just evaporate instantly.
Oh, totally. It indicates a severe lack of conviction at these elevated levels. The market is happy to mark the price up, but nobody wants to commit serious fresh capital to buy the tops.
It's a scary setup.
It really is. This type of divergence, rising price on falling volume near overbought RSI levels, is historically a precursor to a sharp, violent pullback.
Which forces us to look at the analyst notes and the broader valuation debate, because our sources show a massive split in how the market views this asset right now. You have tactical traders leaning into the momentum, but the fundamental analysts are basically pulling the fire alarm.
Yeah, the ratings are a mess of contradictions. The tactical ratings are overwhelmingly bullish for short-term plays. The algorithms that trade purely on moving average crossovers and momentum are heavily long.
Strong buy across the board for the short term.
Right. But the quantitative analysts, looking at the underlying Nasdaq 100 components, they are raising severe warnings.
Yeah, I was looking at the Nasdaq 100 multiples driving this. The Shiller PE ratio and the Buffett indicator for the underlying tech giants are stretched to historic extremes.
Very stretched.
In fact, one of the analyst reports from Seeking Alpha literally labels buying T2QQ right now as reckless for long-term holders. The argument is that you are buying into an overextended mega-cap tech rally at the absolute top, and you are doing it with 3x leverage.
Which is incredibly dangerous. Buying a leveraged product when the underlying index is trading at a premium multiple means any standard mean reversion in the tech sector will be amplified into a devastating portfolio loss.
But hold on, here is the piece of data I just can't reconcile.
Right.
Analysts are publishing reports calling it a reckless value trap. The technical volume is flashing exhaustion. Yet I'm looking at the institutional ownership data over the last 12 months, and the biggest sharks in the water are swimming straight toward it.
Yeah, the inflows are genuinely massive.
We have 328 institutional buyers generating $1.32 billion in inflows. That completely eclipses the 137 sellers who pulled out, what, roughly $373 million?
It's not even close.
And we aren't talking about small family offices here. The top holders listed are Susquehanna, Jane Street, and Citadel.
The heavyweights.
Right. These are the most sophisticated quantitative firms on the planet. If the fundamentals are overvalued and the volume is exhausted, what do Citadel and Jane Street know that the retail trader doesn't? Why are they pouring over $1 billion into a so-called trap?
Well, it comes down to a fundamental misunderstanding of how market makers and high-frequency trading firms actually utilize ETFs.
How so?
When a retail trader buys TQQQ, they're usually making a directional bet on the tech sector. They want the line to go up.
Right, they want to make money on the trend.
Exactly. But when Citadel or Jane Street buys TQQQ, they're often entirely delta neutral.
Meaning they don't actually care if the price of TQQQ goes to $80 or drops to $20?
Not at all. They are exploiting the extreme liquidity, that 104 million shares a day we talked about, to execute complex hedging strategies or arbitrage operations.
Okay, that makes more sense.
Yeah, so Jane Street might be an authorized participant, meaning they have the ability to create or redeem massive blocks of TQQQ shares directly with ProShares.
So if the price gets out of whack.
Exactly. If the price of TQQQ temporarily drifts away from the net asset value of the underlying Nasdaq futures, Jane Street will step in, buy the cheaper asset, sell the more expensive one, and just capture the microscopic spread.
They're acting as the plumbing of the market, harvesting pennies millions of times a day.
Yes. Or they might be using it to hedge massive options portfolios. Like if a market maker sells a massive block of call options on the QQQ to a hedge fund, they suddenly have huge upside exposure.
Oh, so they can buy TQQQ to instantly delta hedge that risk?
Exactly, the mechanism. Their timeline is measured in milliseconds, hours, or maybe a few days. They're utilizing the instrument for its structural properties, liquidity and leverage.
So when an analyst calls TQQQ reckless, they aren't talking to Citadel.
Right. They are warning the retail investor who is logging into their brokerage account, buying a block of shares, and planning to hold it for a year to fund their mortgage.
Two completely different worlds.
The retail trader and the institutional algorithm are playing completely different games on the same board.
That structural mismatch brings us to, honestly, the most dangerous element of TQQQ. It's the hidden mathematical drag that systematically destroys long-term portfolios, even if the overall market actually goes up.
Yeah, this is crucial.
Let's weigh the bull and bear cases, because the bull case is undeniably seductive.
Well, the historical performance of the bull case is staggering. If you zoom out over the last 15 years, TQQQ has outperformed the unleveraged base QQQ by a factor of 10.
A 10x outperformance.
Yeah, it perfectly captured the massive secular tailwinds of the transition to cloud computing, mobile architecture, and now, the AI revolution dominated by mega caps like NVIDIA, Apple, and Microsoft.
So in a low volatility, steady uptrend, the compounding effect of the daily leverage creates exponential wealth.
It does.
But the bear case isn't just about the market going down, is it? It is about a structural vulnerability engineered directly into the fund, the warnings in our sources around volatility decay, and the daily reset risk.
Yes.
Daily reset.
The math here feels almost predatory if you don't understand it.
Well, path dependency is the perfect term for it. The mandate of the fund is to deliver 3x the return for a single day. At the closing bell, the leverage is completely reset. Over a span of weeks or months, the mass diverges completely from 3x the underlying index.
Let's walk through the actual math of that volatility decay, because it's wild. Imagine the Nasdaq 100 suffers a brutal 10% drop on Monday. TQQQ drops 30%, right? So a $100 position is instantly crushed down to $70. Now, on Tuesday, the market realizes it overreacted. The Nasdaq rallies 11.1%. The underlying index is back to square one. It broke even.
But the leveraged fund does not break even.
On Tuesday, TQQQ goes up 3 times that 11.1%, generating a massive 33.3% gain. The problem is that 33.3% gain is applied to the new depleted base of $70.
Oh, wow.
Yeah, a third of 70 is roughly 23. So your position climbs from $70 to $93.
The Nasdaq is completely flat over the 2 days, but the TQQQ holder is sitting on a 7% structural loss. The math just literally ate your capital.
It did.
I mean, it's like trying to walk up a down escalator. If the escalator is moving fast, which is a strong bull market, you get to the top in record time.
Right.
But if you just stand still or the market just goes sideways, the mechanics of the escalator, the daily reset, will drag you all the way back to the bottom.
That is a perfect analogy, and that variance drag accelerates aggressively during prolonged drawdowns. You only have to look back at the tech sector bear market in 2022.
That was brutal.
The Nasdaq suffered a painful correction, but TQQQ experienced drawdowns ranging from 80% to 90%.
90%.
Yeah. And surviving a 90% destruction of capital requires a psychological fortitude that very few retail traders actually possess. Most just capitulate and sell the absolute bottom.
And the math of recovering from a 90% drawdown is insane. You need a 900% gain just to get back to your original buy-in price.
Exactly.
But our sources point out a theoretical risk that goes far beyond a painful bear market. There's a structural wipeout scenario built into the 3x leverage model.
Oh, the wipeout scenario. The math of leverage is entirely unforgiving because the fund promises 3x the daily return. A single-day drop of roughly 33.3% in the Nasdaq 100 would result in a 100% loss for TQQQ.
A 100% loss.
The net asset value would hit zero. The entire $24 billion fund would be vaporized.
Effectively bankrupting the entire fund in a single session. Now, the modern market structure has circuit breakers, right? If the S&P 500 drops 20% in a day, trading is halted for the rest of the session.
Right.
Which theoretically prevents that 33% intraday crash.
Theoretically. The circuit breakers mitigate the intraday risk, but they do not eliminate the overnight gap risk.
What do you mean?
Imagine a catastrophic geopolitical shock occurring on a Sunday night. The futures market limit downs, panic sets in globally, and the Nasdaq opens a regular session on Monday morning down 35%.
Oh, man.
The circuit breakers trigger immediately, but it doesn't matter. The price is already gapped past the point of total ruin. TQQQ opens at zero, and the fund is liquidated.
It is a low probability, infinite severity tail risk that every single holder is implicitly accepting.
Yeah.
So synthesizing all this data, the explosive 26% weekly gain, the algorithmic institutional buying, the bearish volume divergence, and the existential threat of volatility decay. What is the ultimate outlook for you navigating this ETF right now?
The data forces us to fragment the outlook into specific timeframes.
Yeah.
In the immediate short term, things are volatile but distinctly bullish.
Driven by the macro environment.
Exactly. We've seen a rapid de-escalation in geopolitical tensions between the U.S. and Iran over the past week.
The market was pricing in heavy disruptions to global supply chains and tech shipping routes. With that threat receding, capital just flooded back into risk assets, effectively greenlighting this massive tech surge.
Right. The immediate momentum is upward, fueled by that macro relief. But pivot to the medium-term outlook, spanning the next 1 to 3 months, and the quantitative models in our research flip to bearish.
Bearish.
Some predictive models are forecasting a steep 21.7% decline.
You're driven primarily by mean reversion. An asset tracking a fundamentally overvalued index cannot sustain a vertical trajectory on shrinking volume without eventually, touching base with reality.
The elastic band is stretched too tight. The algorithms that pushed it up will be the exact same algorithms that ruthlessly shorted on the way down.
And long term.
If we look long term, the secular AI growth is constantly fighting a brutal tug-of-war against volatility decay.
It really requires a fundamental shift in how you view the asset. It is not a buy-and-forget investment. It is a highly specialized, incredibly sharp tactical instrument. It is designed to be deployed for specific, short-term momentum captures or complex hedging, and then put back in the toolbox before the decay eats your hand.
Treating a daily leveraged derivative as a long-term compounder is basically fighting against the very mathematics of its construction.
So we leave you to ponder this as you review your own portfolio. You now know the massive institutional inflows utilizing it for high-frequency plumbing. You see the short-term buy signals clashing with the exhaustion in the volume profile.
And you know the catastrophic risk of a single 33% drop.
Right. Knowing that the system is literally designed to decay if it stands still. Are you confident enough in an uninterrupted tech boom to play a game where the house resets the rules every single day?